I'm not, Sarah. I would have taken it today, but last year the banks were pretty weak. I think the earnings were good. Net interest margins were higher, but you would expect that with interest rates being up. Loan growth is growing, and I'm still not convinced that Goldman's not going to have a big hit as a result of Malaysia.
What, Eugene, Rick, what's your take on the beige book?
You know, the beige book, I think, is in sync with the trends that we've seen in the domestic economy, many at the expense rubbing off from the global economy. And I think the market's pretty much in sync with it as well. I think that's why there was very little reaction, even though the day in its entirety was actually a pretty interesting day. The dollar continues to fight, mostly at the behest of a weakened euro with regard to how investors are eyeing the future of the Eurozone and their biggest two or three economies, not necessarily firing on all cylinders. I think on the interest rate front, the highest yield close of the year is about 274, just under 2 3/4 for a 10-year. And if you look at an intraday chart for all of 2019, we've been bumping against it. We did it again today. I think we're chipping away at that. And I think what I specifically like about how the markets are in sync with the beige book, that things are okay, just not as okay as they were, is because I really think that the long end to break out here, there's a lot of channels on why people would sell the long end, but I think the biggest channel to pay attention to is just economic fundamentals. And the partial closure might not be a big deal when it comes to GDP, but I think it's a big deal because it really does rob investors of more signals at a relatively important juncture with regard to rates for the rest of 2019.
Eugene, how are you reading the economic data and the corporate earnings that are coming through as they relate to what's in store for the market and the economy for this year?
Yeah, I think that this earnings period is one of the most important of the last few years. I think that economic data has been weakened to some extent. I think the government shutdown, the global concern or uncertainty is really causing a situation where corporate earnings are going to be challenged. You still have the trade war issue going on with respect to China. And so at Profit, we've been actually looking to take advantage of the sell-off last year to reposition to some better names that are, but also are well suited for sort of a downturn in the stock markets. We think the second half of the year we would actually see.
How NVIDIA for a downturn?
Well, if you look at NVIDIA last year, NVIDIA was down over 60%, and yet it's growing at a 38% sales growth rate. It had a bad earnings announcement a quarter ago, but yet we think investors aren't looking at the autonomous driving segment of the market, the gaming sector, and essentially you're looking at a stock that's at a 21 PE, but that's at a 1.3% dividend yield. And when the market, comes back, we think it will be a good one in 2019. It's not a cheap stock in general, but just based on the fact that we think the sell-off last year was much too great.